Welcome, everybody. My name is Jeff Amrine. I'm the managing director and founder of the Startup Junkie, and we work closely with our partners, the Conductor. Welcome to our digital library. During the course of many different episodes that we're going to feature, you're going to learn about Lean Canvas, how to run a startup, how to build a startup, customer discovery, and a variety of other topics. Welcome. We hope you enjoy it.
Hello, I'm Martha Londagin. I'm an executive business consultant with the Startup Junkie Foundation. And today I'd like to talk to you about small business loan funding options. I'll be occasionally referring and looking down at my slides, which will be provided for you on the screen as you go through this presentation. We appreciate you coming to talk to us today and learn about how to fund your small business. I have another series that I did that talked about all the steps to go through if you're thinking about starting a small business or taking a side hustle to a more formal manner. And in that presentation, I talked a little bit and touched on financing and the different ways and manners in which people finance small businesses, and especially startups, or grow an existing small business. Today, I'm going to go into it a little bit more in depth, give you background information on the different requirements and the pitfalls to watch out for and things to think about with financing a business. So, slide I'm looking at now that hopefully you're seeing as well talks about the sources of financing. So there are many places from which financing comes. One of the first you'll see is your savings. A vast majority of people I know who start small businesses start with their own money. They buy a piece of equipment, start making a product, traveling to shows, selling to a couple of stores. The savings part is something that you have to decide from a personal perspective of how you want to spend your money and how much and in what manner. One of the things I advise that's most important with this is from the very beginning, document your personal use of funds toward a business. Keep that invoice for that lawnmower that you purchased. Keep that invoice for that new computer software system for photo editing. Whatever it is, keep the original invoice and screenshot or keep a copy of the way in which you paid for that to prove it. Because in the future, if you seek some of the more complicated funding mechanisms, such as loans that we're going to talk about, that can be used as proof of your cash infusion into the business. And especially if you're seeking a $500,000 loan, 10%, which is the minimum amount you're going to have to prove that you've invested in the company already, is $50,000. So if 6 years ago you spent $10,000 on a piece of equipment, but you've changed banks, you can't access that canceled check, you don't have that invoice, you're going to have to come up with another $10,000. Whereas if you have that piece of equipment and you can prove you purchased it, you can do a bill of sale and title it over to the business, and then that counts as part of that personal injection into the business. The next item you'll see on the sources of financing list is friends and family. Very, very common for people to get loans from relatives. We work with a lot of young entrepreneurs since we're based in Fayetteville, Arkansas. The University of Arkansas has spawned some very, very reputable and large businesses started with University of Arkansas students when they were juniors and seniors in college. Many of those students, some that I worked with, started with loans from their family or donations from their family. The thing I advise you about this is I don't care if it's parent to child. I don't care if it's Aunt Sally to her favorite nephew. You need to have some documentation of that loan. For example, a small business attorney could very easily make you a note and a loan agreement. Not just the note, especially if the note doesn't have all the payment terms in there, but have an actual agreement between you and the person that's loaning you this money as to how it's to be paid for. This becomes very, very important because if you just take the cash and then Aunt Sally goes bankrupt or Aunt Sally passes away, that note that you owe to Aunt Sally becomes an asset of her estate. And you don't want her heirs saying, oh, I know you say she gave you a 5-year note and you're only 6 months in, but we want all the money now. And then that becomes a lawsuit. So it's very clear that you address what the exact loan terms and agreements are. And you need to keep those copies because if you seek a bank loan later in some manner, they're going to have the right to know about that loan agreement, and you should have that to produce to them to show them other debts that you have or that the business has. Lastly, on friends and family, it seems like a personal issue, but it's something you need to know. It is rare when people loan people money that issues don't come up. There are expectations, and you need to be very clear that the relationship with whomever is loaning you this money, be it a friend especially or a family member, is worth some potential issues regarding your relationship if you aren't able to pay the loan back. The next one on the list is leasing companies and equipment lenders. These are really good resources, especially if really all you need is a big old piece of equipment. If you're wanting to start a dump truck company and you already have been driving dump trucks for someone else, you're fine. You have your own money to fund the first few months of, maybe setting up a website and doing some marketing, or living on the income that you've saved from your other job. And really all you need is that dump truck, or all you need is that major piece of equipment. Then those are great resources. A lot of times the vendors selling those items actually have their own leasing forms and leasing programs or purchase. And also, leasing is a great thing to think about. You're not so committed to a major permanent debt at the beginning when you're not really sure if the business is going to take off. So those are some great options to think about if those are the only things you need money for. Bank financing, we're going to talk a little bit more in depth about that in some of the slides to come, because there are many different types and options. Banks have multiple lending programs. And so we'll talk a little more in depth about that. We'll also talk about some of the alternative financing option groups that are out there. Alternative financing doesn't mean negative. There are some incredible, excellent alternative financing micro lenders in Northwest Arkansas. There are some alternative financing online lenders that are horrific, that I have personally known people have just not been taken care of well by those lenders at all. Partially their own fault for not reading the contracts and understanding it, but also partially by just being passed around and not helped and not assisted by an online lender that is a faceless entity. So, general comments about all business financing. Obtain a commitment before any binding agreements are signed, like leases or order for inventory. Don't think that just because you're a good person and you've always paid your home mortgage and you've never been to jail that you can get a bank loan. There are many factors that go into whether or not a bank makes you a business loan. I tell people small business loans are the absolute most risky loans there are. There's a whole scale. You start here with a young couple, 2 jobs, buying their first home. It's real estate, it's dirt, it's solid collateral, especially in a place like Northwest Arkansas where real estate typically only appreciates in value. 2 people with jobs. More month than money at the end of the month, they're going to make their home loan. So you're going to see rates at 3.8, 3.9%. You start going up the scale, as long as you stay with real estate, even investment real estate, rent houses, the rates are going to go up a little bit. The terms, the length of payments are going to get a little shorter because the bank wants to keep you on a tight leash, make sure you're doing a good job. Then you start getting into business loans. Now, existing business loans, or a dentist coming out of dental school. We know there's a market in Northwest Arkansas for dental care. So that's even a little less risky. It's a small business loan, but it's a little less risky because the consumer market need is very obvious to everyone. Then you start getting into things like stores, service providers, marketing companies, restaurants, bars. And then I always tell everyone the upper echelon is putt-putt golf. And that's why today we only have one putt-putt golf course in Northwest Arkansas. We've all seen lots of putt-putt golf courses come and go. Anything that's entertainment that's not necessary to life, that's a small business, you're going to be getting very high interest rates, very short terms. It's going to be really hard to get a small business banker to fund it. Not because you're not a great person, not because you don't have great credit, not because you don't have good business acumen, but they don't want to fund a putt-putt golf. So just don't sign any lease agreements or any agreements of any type until you know you have a loan that's going to close. And I mean, you're set to close it. I advise people to not sign any contracts until after their loan closes and they have the money in their new business account. But you could also see if they would possibly sign it with a contingency clause, such as like when you buy your first home and you say, I want to buy your house and I want to buy it for this much. It doesn't say on blank date, I'm going to buy it. It says contingent on the home inspection, contingent on me getting a home loan approved. So just be very, very careful about that. Grants. I often have people call and say, I'm a woman who wants to own a business. I'm a disadvantaged minority. I'm a low income person. Are there some grants to help me start a small business? There are many programs in the United States to encourage small business development in those groups, and our government should do that. We have historical, factual documentation where minorities and women and low income people have been grossly discriminated against for improper reasons throughout the history of the United States in business lending. Those times are changing, and we're all very glad of that. There are some extra benefits and ways the government's trying to make up for that with government contracting. And I think sometimes this is where people get a little confused about grants and loans. Government contracts are where a city, a state, a county, or the federal government puts out a call for a service. There is no service, there is no product that the U.S. government in some manner does not purchase. Hay for horses in state parks. Hummus for prisoners in Arkansas who don't eat meat. There is every type of product and service sold. One of the ways our government is trying to make up for discrimination in lending is they're doing set-aside contracts. They'll have a construction job and they'll give first preference to a properly certified woman-owned business. Or they're advancing a new food initiative in the prison system and they'll give first right to bid to a minority business. And so I think that kind of bleeds over a little bit into traditional business loans. People think there might be loans out there. Grants are from philanthropic persons or from the government to support a nonprofit group or mission that provides a public service. So churches, even if they operate a public kitchen to serve food to people, local children's groups who provide needs and services to special needs children and their families, they can apply for grants from philanthropic groups or the government to help them serve those people. And the reason the government supports that, the reason the IRS lets people have a tax deduction for giving to them, is they're performing a service that, but for their service, feeding people who don't have a home and food, helping children with special needs to grow and be wonderful leaders and citizens of their community. If those groups do that, our government doesn't have to fund it. Our government doesn't have to provide a program. So the IRS is happy to give you a tax deduction if you do that. The government is happy to maybe have certain grants that go to those people because it's serving society a good. The fact that I want to open a fancy women's shoe store in Fayetteville, Arkansas, is not a service to the public the government's real interested in funding with grants. So that's the difference. That's what grants are for. Now, the government is interested in me opening my fancy women's shoe store because, one, it will produce revenue that is taxable. Sales tax, going to help my city, my county, my state. It will produce income for me that I will report on my tax return. Taxes to the government. It will hopefully employ people, and they in turn will have income to stimulate the economy and pay taxes. So what we have, and what we're going to talk quite a bit in here about, are government loan programs administered through banks that help small businesses. Also, one of those is through the United States Small Business Administration, probably the largest government-backed loan funding program in the world. And in that, they often provide assistance to women and minorities by providing consultation centers. And I'll talk in this presentation a little bit. We have one of those in Arkansas called the Arkansas Small Business and Technology Development Center. We have a women's business center in South Arkansas that specifically helps women. And the reason I mention women a lot in business in Arkansas is because in 2017, our governor rewrote the definition of minority business for Arkansas to include not only certain racial classifications such as African American, Hispanic, Latino, but also women, because only 24% of all businesses in Arkansas are owned by women, and women comprise roughly 50% of the population. Nationally, that number is closer to 38, 39%. So we do have a great initiative in Arkansas to support women business owners. And so there are programs to assist them, but there are not specifically that I know of any bank loan programs just for women or just for minorities. Don't expect 100% financing. Everything we talk about today, I'm going to talk about cash infusion, owner equity investment. And sometimes we say equity instead of cash, because if you fully own a $50,000 dump truck and then you retitle that into the name of the business and you can prove that you use your personal funds to pay for it, that equity injection is seen as the same, as long as it appraises properly, by the bank as a $50,000 cash injection into the business. And whenever I talk about a cash injection or down payment or your buy-in on the loan, that doesn't mean that you give the bank the money and they just keep it. It means that you would put that cash or title over that piece of equipment to the business, use those funds for the business, and then the loan would come in behind that. Be aware of online lenders in all of this that we're talking about. What happens, unfortunately, is two things with online lenders. These are the horror stories. One, people think it's faster and easier than dealing with the bank. Yes, it is. But there's a reason it's faster and easier, and you're going to pay for that. People don't read the fine print. They see an online small business lending program that says 3% fees, and they think that's a 3% annual interest rate. And it's not. It's a 3% daily fee on the balance, which calculates out to about a 27 or 8% annual interest rate. So people don't read the fine print, or people are adverse to debt, their business is doing fine, and then they hit an emergency or a great opportunity to purchase a bunch of inventory or a piece of property or a piece of equipment comes up, and they need to hurry and buy it or hurry and get money to save their business, and they just sign up for one of these quick turnaround loans, not realizing it's a very short term, it's huge payments, massive interest rate, and they get in a bind. So a lot of what I'm going to talk to you about today is, while you're in a position that you have a good credit score, that you have a good future outlook for your business, try to get at minimum a good line of credit from a bank, from real humans that will help you with your business to help it grow. So, a little more about the friends and family. Benefit is you can borrow the funds on your own terms, set your own interest rates. I would check around in public and see what the terms are to just make sure that you protect yourself. There's no restrictions on the proceeds unless they put that in the agreement. But once again, highly advisable to hire a local attorney to draft a formal loan agreement, a note, and if you're putting up property to secure it, absolutely 100% make sure that's done correctly. It can cause the personal issues that I touched on earlier. Also, the other thing is friends and family loans don't help your credit score. They're not reporting to credit bureaus that you've taken out this great loan with them and made all the payments. So it's another benefit of doing your credit through a reputable bank or a reputable lender, is it can help improve your credit score. And then lastly, the thing I touched upon earlier is make sure you have this agreement in place, because if this friend or family member passes away, their estate and heirs are involved, or if they change their mind and want their money back and decide to sue you, and all you have is a conversation, that is going to be a very messy lawsuit. Savings and retirement plans. When I was a small business banker for several years, I would have people ask me about cashing in their retirement plan. The benefit is it's your money already. There is a program called a ROB, a rollover for a business startup. It doesn't cause a penalty for the withdrawal from your 401k, and it can also be used for existing businesses wanting to grow. The only thing I will say is, with the ROB, make sure you use a very reputable company to walk you through those steps, because anytime in life you tell the IRS you don't owe it money or you don't owe it a penalty, you better be right. This is certainly something you would never want to attempt yourself, and be prepared. The rumor is people that do ROBs typically get audited within a few years in their business and in their personal. So be very, very careful to only use a company that does this on a regular basis for small businesses and has been successful. You will need a separate attorney and accountant. That's how complicated this gets to set up a new C corporation to own the 401k proceeds. You're just going to need absolutely very good expert advice, and I would not advise it for something that's a small loan, especially because of all this. And the danger is for all of this, if you cash in 401k and the business doesn't go well, not only does it trigger audits, as the slide reminds you, but you've diminished your retirement. And that was probably not your plan when you were setting up that account. Your plan was to have your retirement account be for your retirement. So be very careful in making those decisions about draining savings and retirement plans. And as someone who's been married for almost 34 years, if you have a legal spouse and you are draining personal savings and retirement plans to start a small business, I would make sure that your partner is on board with this. The next slide you'll see here talks about leasing, and I touched on that earlier about leasing equipment or getting just equipment loans, which are their own special product. Leasing is a great process because it's often very quick because you're not having to get a permanent loan. You may not even have to put any money down to lease the piece of equipment or the truck or whatever the item might be you need for your business. And you don't actually own it. So sometimes there are even lesser insurance issues. But the other thing is you're not building equity in your business. So you really want to kind of shop around, and it depends on your personal situation. If you can't get a loan because you have a low credit score for the equipment, then the leasing may be your only option. But make sure that the leasing payment is significantly lower, because otherwise, if you're in a position to buy the equipment and it's good equipment that lasts a while, that might be a better investment for your business. There's less financial paperwork. So if you have a lower credit score, leasing companies are not as strict in their underwriting as banks may be. There are set interest rates offered, whereas banks might have better rates. Their rates might float, or depending on the type of equipment, especially if it's a vehicle or some equipment that has a long life, the bank might give you a better rate on that. And all of this is a total picture. They're going to look at the type of equipment, how well it would sell at auction if you went bust, your credit score, your experience in the industry, and you can play with the term, a longer term but a higher interest rate, or a shorter term and a lower interest rate. That comes up with the loans, but in leasing, just make sure and compare it to loans as well. Factoring companies. There's a national one online called Blue Vine that's very well known, or any company that calls themselves Blank Capital Company. A very reputable one in Arkansas is Exchange Capital Corporation and Diversified Resources. And so what they do is you have an account and someone in a few months is going to owe you a whole bunch of money. And they're a really reputable company and they've always paid well, but you need that money now. A significant portion. Maybe you've had something bad happen at work, or you need that money now because you've got an opportunity to buy a bunch of inventory at low cost or buy out a competitor. And so these can be very quick. What you're basically doing is selling the factoring company your rights under that contract or that account. No interest rate is charged, but they're going to take a big chunk of that contract. And so, it's going to be 50 to 80%. So say you're owed $100,000 on a contract, but you're not going to finish the work for 2 months. The factoring company might give you $50,000 today, and then they're going to get the other payments. So that's something that can be negotiated with the factoring company. You won't get 100% of your payment. They will get some cut of that. But especially if you really need the money right now, that's something you can work with. The main thing is to work with a very reputable factoring companies. Trucking companies do this very often with their accounts and payments that are due to them. It is only for businesses with regular large accounts. Some manufacturing companies do that when they have a contract to produce a large load of product for someone. IT companies do this also. So online lenders, I briefly touched on those earlier. Some of them are like Kabbage, which you can see on your screen is Kabbage with a K, Prosper, StreetShares, They provide working capital only, which means money for just regular monthly expenses. These are not loans you're supposed to take out for like to buy a building or something like that. They're just business operating and smaller equipment. The main thing is you need to really know what that payment is. We're talking 6 to 12 months versus you could get a line of credit at a bank, which would be a better deal for you if you just need some basic working capital. Most banks don't ever do 6 month short-term loans. They're going to give you longer terms at minimum, like 2 years. So really check with your bank first and be certainly certain that there's no way a local community bank can make you this loan before you go online. They are faster due to minimal requirements, but they charge fees and not interest. And many of these online lenders, their rates are up in the 20% area. Credit cards, I've told people before you'd be better off getting a credit card. About a year and a half ago, there were people getting business credit cards for only 12 and 14%, whereas used to they were up in the 20s. So, I would rather see someone get a credit card, a business credit card for a fast loan that they just absolutely have to have versus some of these other online lenders. Crowdfunding and microloans. Crowdfunding has become very popular in recent years. There are different types, and you need to understand the difference with them. They are typically for startups or for community projects. Some well-known ones are Kickstarter, which is one where people come in and they will give you money for your new product for your business, but you have to give them something in return, such as if you're launching a new board game, the minimum buy-in is they have to give you $50, and they'll be one of the first 100 people to get the new board game. And then you need to be sure that with that $50 and your margin on making that board game, that you're still going to be able to get it out there. And the idea is this funds you to get it out to a mass market, and then people find out about it, and then you can garner investors or raise more funds afterwards for your business. Indiegogo is one. It's typically more for creative projects, Crunchbase, etc. So there are lots of those different types out there. But those are all for-profit fundraising avenues, which means if I loan you $10 or donate to you $10 on Kickstarter, you're only going to get about $9 of that. Kickstarter is a for-profit company. It's going to take a cut. Same thing with GoFundMe for personal things. If I donate to you $10 for your sister's funeral, there are going to be fees taken out. If I use PayPal, if I use Visa card, there's fees coming out. There are platform fees. Kickstarter and GoFundMe both. Every transaction, be it $10 or $100, they get 30 cents. So those are for-profit companies, and they're going to take a cut of the donations that you get. Online promotions cause people to pledge loan funds or to donate to people. And sometimes the person asking gets the money regardless of reaching a goal, and sometimes not. So they're all different. Sometimes the goal must be met before the funds are ever released. One thing to think about with all of these is privacy. Realize crowdfunding means on the internet. You will be out in the public. So if you do a Kickstarter campaign, people are going to want to know who you are and where you make your product and how they get it. Startup Junkie is a official Kiva hub. Kiva.org is an online lender for people to crowdfund loans that they pay back. But Kiva is very different from Kickstarter and GoFundMe in that Kiva itself is a nonprofit. So very wealthy people, benefactors, foundations who care about minorities, low-income persons, people recently released from incarceration, immigrants, people who want to support them to start or have a business will donate money to Kiva. And that's why Kiva's loans are 0% and no fee, because they get donations from the public to fund the people who run their program. And PayPal, that's why you have to use PayPal with Kiva. You can't use anything else. PayPal donates the use of PayPal's system to Kiva, and of course receives some sort of very large in-kind donation because Kiva is a nonprofit. And so with Kiva, you go through a process, you fill out an application. If you're approved, you seek people to give you loans of $25 or more to reach your goal. Kiva, unlike Kickstarter, you have to hit 100% of what your plan is, or you don't get any of the funds. And then every month, say you borrow $10,000 for 36 months on Kiva, which is its maximum. That payment is going to be $277 a month. You send through PayPal your $277 to Kiva, and say it took 277 people to loan you that money. Every month, Kiva will give each of those 277 people $1. They'll put $1 back in their Kiva account. Then after their $25 is fully paid for, or whatever the amount was, they can withdraw through PayPal the funds they lent you through Kiva. So there are also many different crowdfunding options. These are some of the more reputable ones, but understand very clearly and read the directions very clearly about how you are to accept those funds and how you are to pay them back. Or if they are a donation, realize that the people are not getting all of what you donate to them, but there are some fees involved. Now we'll talk more about traditional loans. And so I have a background as a small business banker. I was a small business attorney, a banking attorney. I'm licensed in Arkansas and Oklahoma. For about 7 years, I worked at a very large law firm in Northeast Oklahoma, and one of my best clients that I just really enjoyed working for was a very large community bank. And so I did a lot of bankruptcy, foreclosure, and collections on loans. Then as a small business banker at a bank in Northwest Arkansas, I did SBA small business lending. So I've kind of seen all the routes of that. I spent 4 years at the University of Arkansas in the Arkansas Small Business and Technology Development Center as a business consultant, and I work now doing that at Startup Junkie. So I have worked with people planning to get a loan, giving people a loan, and the unfortunate downside of when a business loan goes down. So there are two main types of traditional loans. There are many other packages. The U.S. Small Business Administration, in fact, offers export loans, disaster loans, short-term loans, funding for certain types of contracts. But these are the two main types of loans: principal and interest. Set monthly payment, different terms or years, and that's dependent on the collateral. If there's dirt and land, good dirt and land involved, you could see a term of 25 years on certain types of loans. If there's absolutely no collateral, just money to pay some bills, it's going to be a very short term because that's risky and the bank wants the money back very quickly. The Wall Street Journal Prime is where the banks borrow money from the federal government. Banks don't keep millions and millions of dollars in a safe. They borrow money from the government. The prime has typically been around 5%. So anything above that is where the bank makes its money on interest. So a percentage is added. With the U.S. Small Business Administration loans, if the bank chooses to administer that program for the U.S. government, they can charge prime plus 275, but that's the maximum that they will be allowed to charge. It's up to the bank. If they think you're a really great small business and you're growing, they might just charge you prime plus 1. They do have some discretion there, but they can't go beyond that. And in-house banks banks with in-house loan programs will make their own decision. They're not operating under SBA guidelines. It will be up to them. Typically, the terms, the length of payments are shorter, but the good thing is they have more flexibility to maybe offer you a lower interest rate than perhaps an SBA loan. So that's where you get the loan, you take the proceeds, you spend it for very specific purposes, and you have a set payment every month. Now, the rate might float. You could maybe get a fixed interest rate if there's real estate involved. So the more and the better collateral, like real estate, equipment, the more likely you are to get a set amount so that you can plan for the future. Typically, small business loans float, so they'll be prime plus 2. So if the prime rate goes down, as it has a lot in 2019 and 2020, your payment goes down. If the prime rate goes up because the government worries we're spending too much money and there's a risk of inflation in the economy, when the prime rate goes up, the next quarter, your bank payment's going to go up. And this happened a lot in 2017 and early 2018. So the great thing about these small business SBA-backed loans is it makes it more likely you'll get one, but do expect to probably have a floating interest rate. So the beauty of a line of credit is that you just have to call your bank officer, she or he, and tell them, hey, I've got a great opportunity. For example, if you own a bicycle shop, I heard about a bicycle shop that's going out of business in North Mississippi, and I'm going to drive down there, and for $10,000, I can buy $30,000 worth of bicycles. So the loan officer drops $10,000 in your bank account there at the bank, and the next month you will get a bill for the interest only owed on that $10,000. You don't have to pay the principal down. Now, every line of credit loan agreement will say you are expected to make major principal reductions on that line of credit. When the line of credit comes due, if you have what we call making it evergreen, if you have evergreen that account where it's always just sitting, totally run up all the way, say it's $25,000 and you owe $25,000 on it for a year, and all you do is pay interest only. There is a danger when that line of credit comes up for renewal that the bank is going to make you convert it to a P&I payment so that they know they're eventually going to get it paid off. And now you've lost your line of credit. So lines of credit can be very helpful, but it's up to you to make sure you use them properly. The place people get in trouble is when sales go down, they just draw off that line of credit to pay bills instead of examining what's going on. Why is the income down? What can we do to get the income up? Lines of credit, if you just go to a great community bank and they make you a typical line of credit, it's year to year. And so every year you'll have to go in and renew it. They're going to look at how you used it and did you pay the principal down like you should. And then it'll cost you a couple $100s to renew it. One of the good things about the SBA program is they have the potential to go out 3 and 5 years on lines of credit, so you don't have to renew them as often. So, been talking a little bit about SBA loans, and I want to talk about them a little more in depth because they are so important, and we're talking here about financing options for small businesses. So it was started in 1953 by an act of Congress to create a corporation wholly owned by the government to guarantee small business loans. World War II occurs, and after the war is over, many persons serving in the military come back. World War II stimulated our economy, which had been very, very bad due to the Great Depression. So many people wanted to start small businesses. We had middle class, upper income women in this country entering the workforce on a full-time basis for the first time. And so many of them wanted small business loans. And the banks were very worried about this. We'd had all the issues with banks during the Great Depression. So the U.S. government knew that small businesses stimulate the economy, and they set up the U.S. Small Business Administration to be a guarantor of small business loans to make banks feel less risky about making those loans. Now, a guarantee is not insurance. If you are driving your car and texting, breaking the law, and you have a wreck, your insurance company will still cover the damage to your car and potentially the liability to someone else you hit or some property you hit. The SBA guarantee program is not insurance. It's not automatic. The SBA has what was last summer, which is the last time I looked at it, a standard operating procedure book that's about 413 pages long. And in it, it says, if you want to be a bank that gets SBA guarantees, you have to do these things. And there are different levels of banking relationships with the SBA. There are preferred lenders who get to generate their own SBA authorizations. There are banks that do more of a general processing. They process the forms and they mail them off to the SBA. There are banks that only do smaller loans called micro lenders. And there are small lending companies that just do SBA micro loans under $50,000. But in all of this, there is an agreement that if the bank or the lender does exactly what they're supposed to, such as the SBA wants 3 previous years' tax returns, not 2, not 1, but 3. If the bank gets all 3 tax returns and has the people fill out the proper forms and verifies the tax returns and gathers a business plan and gathers projections and does all its due diligence, then if the loan fails, not to the fault of the bank, and the bank followed all the rules, the bank can apply to the SBA to pay back 75% of the balance of the loan if it's a P&I loan after they have liquidated the collateral. If it's a line of credit, after the bank has foreclosed, liquidated any business equipment or anything like that that was pledged, the bank can potentially get 50% of what's still owed to it back from the SBA. So these guarantee amounts, which you can see on your slide, are 50 to 85%, depends on the amount of loan and which type of loan program it is. Assist small business owners in getting loans because that makes the banks less worried about making the loans. So look at the bottom of the slide. It says SBA-backed loans are protected for borrower if the bank sells or close. So that is very important. In Northwest Arkansas in 2008 and 2009, we had several banks that went out of business. They were taken over by the FDIC. If you had an SBA loan at that bank and that bank sold to another bank, nothing in your SBA loan changed. You just had a different place to send the payment possibly. If you had an in-house loan and a new bank bought your loan, when they bought the assets of that bank, there were many people who got phone calls from the new bank and they said, we don't like your loan. We don't want your loan. You now are going to renew in 3 months. Good luck to you. Go find somebody else to refinance it, or we're going to foreclose on the collateral. So that's another good thing about SBA loans is once you have one and once it's booked, a principal and interest loan, it never changes. Now, lines of credit will renew more quickly, and they have more flexible terms where the bank can shut the line of credit down, et cetera. But a principal and interest SBA loan is a very solid loan that you can depend upon to know what your payments are going to be. The SBA also provides disaster loan assistance to businesses that don't have SBA loans at the time of the disaster. So you can get an SBA disaster loan even if you've never had an SBA loan before. And those are very helpful to people in times of where a tornado or a hurricane comes into their town and they can't operate their business for several months or years. The Express Lending Program. This is one that only the most seasoned SBA lending banks can become express lenders. These are loans under $350,000. And when banks are preferred lenders, they make all the underwriting decisions. They don't have to send off to Washington, D.C. to get permission. The danger is if they made a bad decision and didn't properly investigate it, it's unlikely they're going to get their guarantee paid. So they have to do their due diligence and know what the SBA process is. Lines of credit can go up to 5 years. Now, if you're a startup, probably the longest even SBA line of credit you're going to get is 2 years. They're going to watch you for a couple years and make sure that you use the line correctly. You draw down $10,000 and 6 months later you pay that off. You draw down $15,000 and 8 months later you pay that off. They want to see that you're using the line correctly. The Express Program lending makes getting an SBA loan faster. And that's why it's called Express. There's not as much underwriting requirements as with like a full P&I loan. There are special fee considerations. So I talked about how the U.S. government set up a separate corporation called the U.S. Small Business Administration. It has many, many, many employees, not only to look at the loans and see that they were properly applied for and granted, but for the life of the SBA loan, the bank has to send a report every single month called the 1502 report to the SBA electronically. And it has the loan number, it has the principal owed, it has the interest, it takes the payments, it tells how much of the payment went to interest, how much went to principal, it tells how many more months are left, when the payment was made, and the bank sends a very small fee, 0.5% annually, to the SBA as well, for the privilege of administering these SBA loans. So there's a massive amount of people who work for the U.S. Small Business Administration. And the way that's funded is every time you get an SBA loan, there is a fee associated with it. And it depends upon the amount of the loan. And I'm not going to bore you with all the different charts about when you pay a 1% or a 2% or a 3% or 3.5. Typically, it's around 3%. So whatever the loan amount is, say it's $100,000 and it's a 75% guarantee by the U.S. Small Business Administration, then that would be, say, a 2% times 75% fee that the bank can loan you, or you can pay out of personal business funds, but that fee is sent from the bank to the SBA. That fee helps the SBA fund itself and fund the employees to support this government program, which builds small businesses in the United States. Now, because it's government-backed, our government does and should always want to give special consideration to veterans. So with the Express Loan Program, you won't have to pay that fee if you can prove with your discharge papers that you are an honorably discharged U.S. veteran. There are also lots of wonderful SBA programs that don't have anything to do with loans, but there are programs that the SBA funds to train veterans how to run a business or start a business. And the U.S. Small Business Administration is very, very supportive of our service men and women veterans across the country. And just like in our government contracting system, there are often set-aside contracts where the federal government contracts for services or products, and they will give special consideration to veteran-owned businesses. And this is all the wonderful way that our government wants to support our veterans in their business endeavors. And so with that, Veterans Advantage Program, another thing, and you can see on your slide that I always like to remind people, is if it is the spouse, the legal spouse of a veteran, they will still have to have that veteran's DD 214 form that shows they were honorably discharged, but the spouse of a veteran can also take advantage of this loan program. So once again, government program. That means there are going to be certain requirements and certain deal breakers. The main thing is SBA loans are for for-profit businesses. They are not for nonprofit 501c3s. Nonprofits, 501c3 entities get special consideration from the government through the IRS that because they're nonprofit is providing a service to the public that is for the public good, that's not political, then the IRS gives a potential tax deduction to benefactors and individuals donating to those nonprofits. So nonprofits are helped through the grant process and tax deductions through the IRS. The U.S. Small Business Administration is the flip side of how the government helps for-profit businesses. So you have to be a for-profit business to qualify for an SBA loan. Now, sometimes disaster loans will be offered from the SBA to nonprofits in a town hit by a hurricane because the government wants that nonprofit to operate again so it can help children perhaps in the community. But disaster loans are very different from regular SBA loans because they come directly from the SBA. You don't go through a bank or through a loan officer. So you must also be small. There is a big, long chart that talks about all the different types of businesses and how the SBA defines small. Typically, if you're a regular retail business, it's under 500 employees. Now, if you manufacture goods and sell wholesale, sometimes you can have up to 1,200 employees. But small means small. It's under 500 employees for sure. And then there are different rates and manners for how much your gross revenues can be. Typically, any gross revenues more than $7 million is not going to be allowable. But there are some that it is even higher depending on, say, you're a small business attorney. That's a small business. They allow it to go, I think it's up to $11 million in gross revenues for a law office. You must use some alternative financial resources, including your personal assets, before seeking full assistance. So the SBA will require, at least for a startup loan, a 10% cash equity injection or proof of 10% equity injection into the business. So that's where earlier I talked about how if you buy a dump truck and just start operating it as a DBA, you doing it on the weekends, hauling some jobs, then suddenly it turns into a full-time business. Make sure you kept the invoice and proof of personal payment for that dump truck, because if that dump truck is now worth $30,000, that can be included as part of your equity injection. You must demonstrate a need for the loan proceeds and that credit offered elsewhere is unreasonable or not offered to you. So the SBA likes to know that you tried to get a regular loan at another bank, or the bank will certify that if it wasn't for SBA, that bank would not make you an in-house loan. Most banks' in-house loan policy book states that they are not wanting to do loans to brand new businesses, that they are not encouraged because they are so risky. And so that's why they'll shift those loans over to their SBA lending team. And the loan funds must be used for a sound business purpose. The borrower who owns the business that's applying for an SBA loan must be a U.S. citizen or have a lawful permanent resident alien card, sometimes called the green card. The borrower, him or herself, cannot have defaulted on any other government-backed loan. It's okay if you got a few months behind a couple years ago on your student loan, but you can't have completely defaulted. If you had an FHA home loan and you walked away from it in 2009 and defaulted, then you're not going to be able to apply and be receiving an SBA bank loan. The idea is once you have reneged on a deal and the government has lost money in a government-backed program, they're not going to make you another government-backed loan. Borrower may not be a convicted felon. Misdemeanors are fine. You know, if you had a DUI several years ago, if you had some other misdemeanor charge, even if drug-related, as long as it was a misdemeanor, there's a form you will have to fill out because it's going to say, have you ever been convicted of a crime? Period. And you'll have to fill out a form and tell your loan officer, yeah, I got arrested for this and I was convicted, but I did community service and blah, blah, blah. So you can do that. Typically, if you are a convicted felon, an SBA loan is not going to be given to you. If it was, say, 25 years ago, there is a process the loan officer can go through to see if the SBA will approve that. But the loan officer can't do that on his or her own, even if they're a preferred lender. They have to reach out to the SBA. Borrower must infuse 10% equity in the business if a startup or expansion. This is important to realize. Even if you've had a great successful business for 5 years in Bentonville, your balance sheet shows huge equity. If you want to open a second location in Fayetteville, first of all, you're going to be smart to open a second LLC because you don't want to put at risk. You want to limit the liability of the Bentonville operation. That is considered a startup in the eyes of the SBA. So even if the business in Bentonville is doing great, you got tons of equity in the business, tons of equity in the property. When you start the new project in Fayetteville, there's going to be an expectation of at minimum a 10% equity injection. So you would have to, as the owner, say it was a $400,000 project, you'd have to put $40,000 cash into a new business account for that new LLC before the bank would loan you money. Borrowers and grantors must pledge all assets available. If you're getting a business loan backed by the SBA to open a restaurant or bar, all of that equipment that you buy, the bank is going to have a first lien, and then the SBA will have a second lien behind that. That's absolutely required. When the loans start getting over $200,000, it is likely that the SBA will also require the bank to take a second mortgage on your personal home or a first mortgage on some farmland you have. They want you to be in on this 100%. And there is historical documented data that proves that when borrowers have pledged personal assets and have put up everything they have, they're going to work harder to make the business be successful. Now, next list you'll see on this slide under the borrower approval basics. A considered business for an SBA loan cannot have caused the government to incur a loss or debt, cannot be owned 20% or more by a person associated with a different business that caused the government to be incurred. This 20% starts coming up a lot. Anytime someone owns 20% of an LLC or a S Corp that is seeking a small business loan, they are going to have to personally guarantee it, just like the person who owns 80%. They are going to have to fill out a personal financial statement, produce copies of their income tax return, and they will be examined by the loan officer as a person who is worthy or not worthy of an SBA loan. If an SBA loan cannot be owned 20% by a person who is incarcerated, is on probation or on parole, or has been indicted for a felony or a crime of moral depravity. The idea is if you are under indictment or you are on probation and you are a 20% owner of this business, even if you have a great job, even if you have turned your life around and are doing wonderful things, if by chance you messed up and went back to prison, or the indictment turned into charges and you went to prison, it's going to put the repayment of the loan on at risk. And so that's why they have that in there. Size standards, I mentioned it a little bit before, but for most retail businesses, they don't want more than $7.5 million in gross sales over the last 3 years, nor more than 500 employees. So those are the size standards because this is the U.S. Small Business Administration. Wholesale businesses, the applicant and affiliates cannot have more than 100 employees. For most manufacturing businesses, it cannot have more than 500 employees. So that's kind of the range in there for the employee standards. Eligible use of proceeds. SBA guaranteed loan proceeds may be used to acquire land. They love that. You can sometimes get up to a 25-year note if you are acquiring land for a business. It can be used to improve a site, and that can be site you already own, or you can get an SBA loan to do the build out to fix up lease space, to acquire and install fixed assets, new equipment for your restaurant in a strip mall that you rent the space, buy inventory supplies, raw materials, provide working capital, especially through the lines of credit. And working capital is just the daily expenses of the business. Lines of credit and working capital loans are not supposed to be for major equipment or for land. But you can get an SBA loan to refinance existing business debt on better terms. So sometimes an entrepreneur, someone wants to start a business and maybe they didn't have a lot of experience, they had a poor credit score, and they took on a bunch of credit card debt to start the business. And lo and behold, 3 years later, the business is absolutely killing it, doing very well. And now the owner is regretting that 19% credit card that they ran up to $150,000. So they can go and show the bank that they have a really good business or business is doing well and seek a loan on a longer term to pay it off with lower monthly payments and at a better interest rate. And it kind of gives them an end in sight for that. So SBA loans can be used to refinance debt. SBA loans are not for long-term rental properties, for religious indoctrination purposes, not for political groups, no money lenders. It has to be an active commerce business, an active business engaged in commerce. There are many different SBA loan programs. The 7A is the most popular, which are just the regular P&I payment loans to start or expand a business or buy equipment or purchase a building. The 504 is a special loan for major real estate building and major equipment. And that's kind of a really interesting loan. The bank ends up partnering with a certified development company, and the certified development company gives the borrower a 30 or 40% of their loan at a very low fixed rate. I think right now they're down in the down to like 2.8, 2.9% for 25 years on land. So if you could get a fixed rate for 25 years on 30% of your loan, that's a really good deal for you. And then the bank ends up at the end just having 50% of that loan as its part that gets paid back with interest. But the bank doesn't have an SBA guarantee on that one. So the 504 is a really interesting program, and it's an excellent program if you are including land in your building and or buying major equipment. It does have some requirements that you produce so many jobs in order to get such a good deal, but that's something you could discuss with your loan officer. There are microloans, which is typically under $50,000. Disaster loans, those are special ones I talked about before that come directly from the SBA, not through a bank. And then the Veterans Advantage and Express program. The SBA provides assistance with government contracting for small businesses. Their consultants will help you bid on selling food to the local county jail. We have at the bottom of this slide on state services, number 9 is the Procurement and Technical Assistance Center. They work very closely with the SBA to help people bid on contracts. If you, I know someone who's a patent attorney, and she bids on government contracts when different government departments or entities have invented a product or a process or a service and they need to get a patent on it, but they don't need a patent attorney all the time. IT companies bid on government contracts. The third one here we talked about earlier, the Small Business Development Centers. We have 7 of those in Arkansas, the ASBTDC, and we have one in Northwest Arkansas in Fayetteville, just off Dixon Street. SCORE, which is volunteer mentors, and the great thing about SCORE is some of them have experience in the nonprofit world, and they will also advise nonprofits. We have a Women's Business Center in South Arkansas, U.S. Export Assistance. SBA loves to encourage Americans to export their goods overseas and sell them, and we'll assist you with that. And we, of course, have the Arkansas World Trade Center located in Rogers, Arkansas in the Pinnacle area, and they have free export consultants there that will help you with exporting and help you to sell your goods in other countries. We have certified development companies. That's the one that I talked to you about that help partner with the banks for the 504 loans. And so they take out a part of the loan. And then when they take that part out, you have really, really good rates due to that. And then the last one, the Procurement Technical Assistance Center. In Arkansas, ours is the Arkansas Procurement and Technical Assistance Center. There are PTAC centers all over the country. Ours started out just in Little Rock. It's a division of the University of Arkansas Division of Agriculture, which seems kind of odd, but that's because they originally started out helping farmers get milk contracts and grain contracts. And now they help people at every area. Max Franks is our current PTAC advisor, and his office is located in Bentonville. And the state of Arkansas pays him to help teach you how to bid on city, county, state, and federal contracts for services and goods. And so one of the examples I give people all the time, they're like, oh, well, that's just for high-level service companies. I'm like, if you grow hay, the state park system in Arkansas buys hay for the horses that take the rangers around in the parks. So there are all different levels of government contracting. Construction's a huge one, but we have all of these great resources and they don't charge you anything. Microlenders. We are very fortunate in Northwest Arkansas to have two really excellent microlenders. Forge, which originally stood for Funding Ozarks Rural Growth and Economy, and now everybody just calls it Forge. They're based in Huntsville. Once again, started out because of agriculture. There were a lot of farmers, especially some organic farmers in the Huntsville area, and they needed help learning how to get government loans for farming. Forge has grown, and just about, I think it was about 5 years ago, they can now do SBA microloans under $50,000 in the entire state of Arkansas. I know people who have gotten Forge loans to start gift stores, a daycare, so they'll work with many different types of small businesses. Their process is a little faster. Their underwriting requirements aren't as strict. So when I was a small business lender, sometimes if someone just needed a $10,000 business loan and their credit score wasn't quite where I could get them approved at my bank, I would send them out to Forge. Also in Fayetteville, we have Communities Unlimited. They're based in Little Rock and Fayetteville, and they are also an SBA microlender, very reputable. Just like Forge, has a little bit lower requirement for documentation and paperwork and collateral, but are a great SBA microlender alternative. The SBA.gov is an incredible website resource. If you care anything about small business, if you are someone who works with small businesses, if you own a small business, if you're thinking of starting a small business, if you're just interested in learning about small business, go to SBA.gov. They have videos about payroll taxes. They have videos about marketing. They have handbooks for ideas about everything in the world to help you grow your business. They have toolkits about how to start a business. They have lots and lots of information about SBA loan programs. So I highly advise you to think about going to that website and just reading through it. Take a couple hours, just click through all of the sections. It's a very large website. It was completely redone and updated about 3 years ago, and it's very user-friendly and has a wealth of information. This slide has a contact information for the SCORE of NWA, Northwest Arkansas. And so SCORE originally stood for Service Corps of Retired Executives. They've gotten away from that because many of the people who work with SCORE are not retired. A lot of times they're business owners and they just want to give back and mentor other businesses. And they offer their services and workshops from individuals who just volunteer. They are not paid staff. I talked to you earlier about the University of Arkansas, ASBTDC. And they used to be associated with the Walton College. They're now part of the Office of Economic Development. So they're just the University of Arkansas Small Business and Technology Development Center. And all of the ASB TDCs in Arkansas are located on college campuses. So they partner with the college to provide entrepreneurship opportunity and give back to the communities in which they are located, so that the small businesses there can start and grow. So now that's all about the SBA, all the programs, all the things it offers, and its incredible website. So in-house traditional bank loans cover everything: real estate, working capital, equipment, startup costs, rental and investment properties. If you have a better credit score, if your business is not brand new, this can be a really great option for you. The bank does not have to follow SBA rules. The bank will often offer lower interest rates if they like you as a small business or as a future small business owner. If things come up, issues come up, you want to release a piece of collateral and sell it and replace it with another one. If you get a month behind and you can talk to your loan officer on an in-house loan and get things worked out with them, it is a simpler process for the bank. And this is where I think sometimes the SBA gets a rap that it's harder and more difficult and takes tons longer. That's really not true. There are some extra forms for you to fill out. For the bank, it is more work to administer an SBA loan. But the banks like that because they get that guarantee backup. It makes it less risky. So if you qualify for an in-house traditional bank loan, if you like the term, you think you can pay it back, you think it's a good deal, and you like the lower interest rate, then it can be a wonderful experience to just deal with a community banker that makes her or his own decisions. They will typically be shorter in term, or even if they're a longer term amortization, say it's a 20-year payout, it's probably going to have a provision where every 5 years it balloons. The good news is if you decide you don't like that bank and you don't think they're offering you a good deal, you can go refinance and get a new loan at another bank. The downside is after 5 years, if you've had a lot of late pays, if the bank thinks you're making bad business decisions, they may tell you to go get someone else to refinance your loan because they are not happy with the way your loan is performing in their portfolio. So there's two sides to that coin. In-house traditional bank loans are typically seen as good loan places for loans over $500,000 if you have 15 to 25% to put down, and you're not going to have that 3% SBA fee. So I've known people who are in very good financial condition that had talked to me about an SBA loan, but they were offered an in-house loan, and the only downside was the 5-year balloon every 5 years, and they liked the rate better, and they did not like the idea of paying 3% of about $500,000 to the SBA for the privilege of having the SBA loan. SBA loans were created for and are really targeted to people who need to start, want to start a small business, but just can't get finance somewhere else. It's our government's way of supporting our small business community and supporting our citizens. This chart is my last slide, and it just kind of shows you the different sides of SBA versus non-SBA loans. And so you can see typically the maturity is longer, which means more payments, lower monthly payments. Another thing about SBA loans to remember that I hadn't mentioned previously is if the loan is 15 years or more, during the first 3 years, there is a prepayment penalty. And the reason is when the SBA books your loan along with hundreds of thousands of other loans each year, it forecasts how much it expects to bring in principal payments on that loan. It forecasts how much money it's going to be lending out. And if you pay your loan off early, it messes up that forecast. And the job of the SBA is to very, very carefully, which they have done for 67 years, administer these funds because they are taxpayer dollars. So there is a prepayment penalty on an SBA loan during the first 3 years, but after the first 3 years, there typically is not a prepayment penalty. For equipment and fixtures, once again, you can see on the second section, SBA loans are longer, so you can have a lower monthly payment. And because it's under 15 years, If you want to pay it off early, you can. So I always encourage startups, especially, or people with growth loans, get the longest term you can. If there's no prepayment penalty, then make those lower payments. The months you have that the business is doing good, pay some extra toward principal. You don't have to pay it just those monthly payments. You can still pay it off early without a penalty if it's a loan of less than 15 years. You can go sometimes up to 25 years on commercial real estate with SBA loans. Typically, in-house banks in the area like to do 15, maybe 20. You can also do a blended loan with SBA, which means, say, you would normally only have 2 years for a working capital loan portion, maybe only 5 years for build out to fix up your space, but the equipment you're putting in and the upgrades you're doing to build out the space would be 10 years. So they might blend it and offer you a 7-year note. There are also export working capital loans, which SBA will give you a loan of that up to 3 years, which is nice to have that working capital and gives you time to grow your business overseas. And then there's the express loans, which are typically called the line of credit loans. And they're the same as the 7A, except the lines of credit can't be more than 1 to 5 years. They can't give you a 10-year line of credit, whereas you could get a 10-year P&I payment to expand a business or start a new business and buy equipment, etc. So that's, in a nutshell, all of the different financing options that I know about. Every business is different. Every business owner's ability to seek funding and gain funding and be approved for funding is different. You have to figure out, 1, what you're most comfortable with, 2, how much money you really need, and that work is on you to determine that, and then 3, what manner you're most comfortable dealing. Is it with a loan officer? Is it with friends or family? Is it with an anonymous online lender? It's finding a fit for your entrepreneur project. So, Martha Londagin with Startup Junkie Foundation in Fayetteville, Arkansas. Thank you for your time.